Welcome to Introduction to Business Management 111 online, offered by Harper College. My name is Dr. George Mochocki. We will be utilizing Blackboard Course Management System in conjunction with this video. Okay, this week we're going to be covering two chapters, Chapter 17, Accounting, and Appendix D, Personal Finance. Let's look at accounting first. A lot of people, what's the difference between accounting and finance? Accounting, if you look at it, let me go real quickly. If I was a dietitian, accounting basically look at it as the actual numbers of facts. As a dietitian, I would have an individual step on a scale, and the person says, this is how much he weighs, this is the body fat, and everything else. No question about it, these are the numbers. I may not agree with it, but these are the numbers. That basically is what my accounting systems represent. It's actual numbers. Here's how much I owe, here's how much I spend, here's how much revenue. You may not like the numbers, but this is the actual number. Now, finance is the next step. My dietitian, what he or she basically does, they'll take that numbers and they'll say, if we change this, if you quit eating the Twinkies, if you go on a diet, if you do rigorous exercise, if you change this, we will basically change your weight and your body fat. After I've done all these things, I go back on the scale, and hopefully everything that my dietitians have told me works well, and now I've lost the weight. The same thing with finance. Finance looks at the numbers, the raw data, the actual numbers, which accounting creates, and takes those numbers and now looks at the ratios and says, hey, we got too much debt, or we don't have enough debt. Where do we get extra capital? How do we expand? Where do we get extra revenues? How do we get customers to come to our stores? What kind of promotional devices do we need? What kind of a pricing should we look at? Should we outsource? All these things, anything to do with money, is what finance is. So accounting and finance, they work together. So accounting is very rigid, very to the point. You can't deviate. Here's the accounting. So if I look at accounting, what do I need in accounting? In business, in your business plan, I'll require 3 statements. And the statements that I'm looking for are basically 3 basic statements: income statement, balance sheet, and what do you call it, owner's equity or cash flow. Okay, so if I have those 3 statements, I have a general idea. For your business plan, you're required to give me one balance sheet, 1 cash flow sheet, and 1 income statement. You could do it for the year or for the 1 month. I'm more interested in going forward in basically the components, not as much as the numbers. You'll get that as you take more classes and you get a better handle on that. So you're going to find out that. You're going to have to understand in this chapter, you know the difference between bookkeeping and managerial accounting. Managerial accounting is a little different. Managerial accounting helps businesses to contain costs on the expense side. It's something that makes me competitive. I know I could reduce my supply by 1% or something else. I'll have a larger profit margin. Okay, what's the difference between auditing? Remember, we all have to get audited. Auditing basically helps me when I do my financial report, my annual report. An auditor comes into the company and says, all your books, everything else is in order. So if I, as an investor or a union member or anyone or supplier, when we look at your books and get the audit report, we go, hey, this company is sound. It is an investment that we could deal with this company because they have good, sound financial manager practice. Okay, so that's about it. Make sure you understand the different ratios. You'll see those again for the test. The ratios, when you look at ratios in accounting, ratios don't mean anything else. You have to compare a ratio, apples with apples. So when I'm comparing ratios, I'm comparing the ratios of Walmart similar to the ratios of Target. I cannot compare the same ratios, liquidity ratios, profitability ratios, to, let's say, a consulting firm or to an auto industry, because they have a different type of a business structure, different type of an operation. Okay, so we have that. The next one I want you to learn, the next chapter we're going to be talking about is Chapter D. It's personal finance. Personal finance and business finance are very similar, just more zeros. A little more complicated, we use a little different terminology, but most of us are, you sign up for the class, you know how to, you purchase a car, you purchase a home, you've got student loans, all that is part of personal finance. Within personal finance, things that we look at is credit scores. Businesses also have a credit score. We also could spend more than we make. Businesses could also spend more than anyway. How do I leverage my good name, or what they call in personal finance the 5 C's of credit? Is my character, my capacity, my capital, my conditions of the contractual agreement, and my collateral. All these are the same principles, same 5 C's of character that I look at a business as I look as a personal. So if you understand those, you can see the difference. Remember, businesses also have to look at credit scores. If they got a poor credit score, they have to pay more. Just like we may have cash flow problems, businesses also have cash flow problems. Only they are a little bit larger because now they can't pay. They can't pay their suppliers. They can't pay their employees for their wages and other things. You look at the tax deferment. Businesses also are looking how to minimize my taxes. I want to give the government what is due to the government. I want to keep what is due to me. So I only give the government as much as the government asks me and is required by law, and I keep what else I need for myself. That is the economic or the market system that we operate in the United States, in the free market world. Okay, so you have that, different investment strategies, different pyramids. You're talking about the mutual funds. All this is basically about accounting. So if you look at accounting, good chapter. Look at the personal finance, good chapter. They all tie in together. Just we utilize some business terms. Instead of calling a check, we call it a demand deposit. Instead of calling it a savings account, we call it a time deposit because we make money and everything else. So anyway, welcome to this week is very interesting. Put your head on, take a little bit longer time. Accounting for some people is very dry. There's not much I could do with that, but you have to understand. Remember, accounting is the language of business. Part of the accounting is the personal finance. When you look at your personal finance, when we go to the next chapters, 18 and 19, we start talking about financial manager and financial management. That will all tie in. So now you understand the accounting, you understand the personal finance, and then when we go into the corporate finance, all this will say, hey, I know a lot of this stuff. Now I've got the new verbiage. This isn't really that bad, okay? So again, this chapter, you will have one forum, and it'll be how do I get out of credit? What does the credit score mean? What are bankruptcy rules? Does business follow by the same rules as an individual consumer? So a forum is an interesting forum, how to get out of credit card debt, how to get out of student loans, how to understand the rules and conditioning of the requirements of any kind of debt obligation I have. My name is Dr. George Mochocki. This week we'll be covering chapters 17, accounting, and appendix D, personal finance, and meeting the forum. It's going to be a very interesting topic, talking about how to get out of debt and then a credit score. This class is offered by Harper College. See you in the forum in a second. Bye.